All right, everyone. Welcome to our very first Tom's Trade Essentials series. All right, this is a series of webinars that we're doing, and most of you in here, the good majority of you here, know exactly who I am, and so I'm not going to spend too much time talking about myself. However, I want to quickly go over for a few of you, a little bit of my background and also what I've been doing lately and what we're doing here in Tom's Trading Room. We're also going to be discussing all about calls and all about puts today. That's basically where we want to take this, and we want to get into some case studies. All right, so that's our plan here for the evening. And again, sessions being recorded. If you have any questions, comments, etc., just feel free to shout them out here in the room. And guys, thanks for being here. And so let's go ahead and get started. Jay, are you there?
I am here.
Well, good evening to you, Jay.
Good evening, sir.
I'm going to be passing this over to you in just a few minutes. Before we begin, I do this at every single webinar, and some of you guys have seen this slide more times than you like. But I put this up here because it's something that we do. It's obviously for both you and I. This you can read this from cover to cover. I'm actually going to leave it on the screen for a moment. You can read it on the recordings. You can see it on all of my emails that go out to you have a disclaimer on it. And this disclaimer is also found on my website, www.tomgentile.com. Says a lot, but I want to hone you in on a couple of areas. Obviously, the very top, stock and options trading have large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and options market. All right, so the one thing we're going to talk about is that Jay and I we're what we call rules-based traders. All right, rules-based traders. And it's tough being a rules-based trader on a week like this week when you have typical strategies that you use, and you get a lot of volatility. And volatility is really tough for everybody. It doesn't. You know how volatility is not tough? If you bought options, if you bought premium a week ago, then volatility is looking pretty good for you right now. But if you are on the short side, if you're selling naked puts, you got to be just thinking, what am I doing going into this weekend selling these puts? Is there a better way? Yes, there is. We're going to get into that. Perhaps not tonight, but we will be getting into that over the course of the next 3 weeks. So this series is going to be run on a course of the next 3 Fridays. The other thing I want to let you know about is that because we're research traders and we're rules-based traders, we look at patterns. And our patterns we do a lot of back testing on, but there's no representation that no matter how good something is in the past, it's going to continue to be good in the future. Okay, keep that in mind. Now, the other thing I want you to keep in mind before we move on is that myself, Jay, and everyone else associated with Tom's Trading Room, we are educators. Okay, we're here to educate you. All right, we're not your brokers. You need a broker to trade with. You must meet certain requirements, and everything we're going to talk about tonight for my friends that are outside of the walls of America, everything we're going to talk about tonight is in U.S. dollars, unless noted otherwise. All right. So let's go ahead and begin. Now, I have a fairly lengthy resume, but really, guys, for the 2 or 3 of you in the room that don't know who I am, I've been trading now since really 21. I mean, at the age of 21 was when I first started trading, and I consider myself a veteran in most of the markets. And a veteran doesn't mean that he's right 100% of the time. A veteran means that I do have a lot of experience in the markets, and I have learned from a lot of mistakes. Right. One of the things that I really missed out on is that I didn't have the kind of training that's available today, because I got my training kind of from the School of Hard Knocks. And then I decided I was going to go to New York, and I was going to work on the American Stock Exchange and learn this business correctly. At the time, I was the co-founder of Optionetics back in the early 90s. Since then, authored several books on stock index and option markets. I've been featured on CNBC, Bloomberg, Reuters, Fox. I also have a weekly talk show, which is on iHeartRadio. And of course, I'm the founder of Tom'sOptionTools.com. All right. I'm also an editor at Money Morning, and also you can find me at PowerProfitTrades.com. But tonight, I am your employee. All right. Jay and I are your employee. We are here to help you learn the business of trading and investing. And so before we get into options education and options basic, I want to take you through a couple of slides that I think are really important. All right. Before you even pick up your first option, your option strike, whether it's a call, whether it's a put, whatever it is, make sure that the stocks that you're looking at, all right, have what I call liquidity. All right, you don't want to be in a situation where you are one of the only people trading something. One of the first things I used to do is I said the more letters that there are in a stock symbol, the less liquidity there is. Well, um, that's true once you get past 5 now, because if you look at Google, for instance, I used to never ever trade a stock that had a 5-letter symbol, because if you remember, 5-letter symbols were not just NASDAQ stocks, but they were pink sheet stocks. But now Google, which the symbol that I follow is GOOGL, is a 5-letter symbol, and guess what? It's one of the most liquid stocks out there. So I can't use my, the fewer letters in a symbol, the more liquid it is routine anymore. I got to do something a little bit more. So I want to show you what I call the essential stock selection process. It's very simple, and it involves using Google, not Google the stock, but Google the company. And so I find the best tradable stocks are found in what's called market liquidity, stock mobility, and that's actual stock volatility, and that they are short-term optionable. All right. And I'll explain what those are very quickly. So first, market liquidity. How can you find the most liquid stocks that trade the most liquid options out there? We don't have to go any farther than Google. If you go to Google and type in the words penny pilot program, and that'll take you to the CBOE. If you go to the CBOE, you're going to find that the CBOE has this hybrid penny pilot program that back in 2009 it was started, and since then it's gained a lot of popularity. In fact, I actually looked today on the Chicago Board Options Exchange website to see. I was looking at weeklies. I'm working on a little program where we're looking at weekly options, and I was interested in knowing how much weekly options traded as a percentage of all the options on the S&P out there. And it used to be 1%, 2%. Back in August, there was a week in August when the China meltdown, the first meltdown was occurring. We kind of got the replay of that this week. But we had the weeklies represented 40% of all the optionable stocks in the S&P 500. And now they're averaging around 20%. So think about this. One of every 5 options now that's traded is a weekly. Most are traded by institutions. All right. So where's the liquidity? Well, the liquidity is going to be in weekly options, but another place you can look is in this penny pilot index. And if you notice here, I've got an arrow that goes down to the bottom and it says click here for a CSV file of penny pilot classes. And if you do that, you'll immediately get that file, all right, that gives you all the stocks, all their options, and now you can get an idea of options that are liquid, all right? That means they trade inside the 5-cent bid-ask window. If you've ever looked at options before, I won't trade options that are 50 cents between the bid and the offer, all right? One way to eliminate those type of stock options is simply pull from this list here. And you'll be pulling about 325 stocks and ETFs that operate inside the 5-cent bid-ask window. Now, it doesn't mean they're going to be 1 by 2, like $1 by $2. What it means is that you might see $1.05 by $1.10, and then you might see $1.04 by $1.11 or $1.04 by $1.09. All right. What it means is that you're inside. It trades inside the nickel, which is liquidity. All right. So keep that in mind. The essential 1%er list. How does a 1%er trade this? Well, 1%er, what I mean by 1% is we take the stock list from 25,000 stocks down to just the top 1% by liquidity, which is about 250. And then add on the ETFs and the sectors, and you're above 300. Remember, this is an ever-changing list. All right. But remember what I'm looking for. I'm looking for stocks on the penny pilot list and stocks that trade weekly options. And when we merge those together, we're really dealing with about the top 250 to top 300 stocks that have options that are very, very liquid. All right. If If that seems like it might be a little too hard for you, then might I suggest looking at maybe the top S&P 100 stocks, or the stocks that trade in the OEX, the stocks that trade on the Dow Jones 30. There's 30 stocks there that are very liquid. The stocks that trade on the NASDAQ 100, those are very liquid. All right, because if you take a look at those three lists, a lot of those three lists are the same as what I'm pulling here from the Penny Pilot list. All right. So at this point, what I want to do is I want to move over real quick, and I'm going to change hands. And I'm now going to give this over to Jay Harris, who's going to talk a little bit about what we call options basics. So Jay, are you ready? You ready to take this thing over?
Yes, sir. I'm ready to go. I'm going to show my screen, enlarge my slides.
You have the ball, my friend.
I do. Okay. Let me know when you all can see.
I can see just fine.
Okay. And volume coming in just fine as well.
Great.
All right. Thank you, Tom. I appreciate the opportunity to jump on board here with some of y'all. Just a quick heads up on me, my background. I got started in the markets during the time our then Fed Chairman Alan Greenspan termed the assessment of the conditions of the marketplace a time of irrational exuberance. You guys remember that? What a glorious time that was, huh? So my association with Tom goes back about 13, 14 years. I started out as a student of his company and then progressed into getting involved as an employee for his company, working in sales department, becoming a event coordinator, an on-site coordinator, where I had the pleasure of meeting a lot of you guys over the years on the great run that we had with that company. And it's a great opportunity for me to be in an independent contractor role with Tom and his current company, where he's gotten the band back together. I'm part of that band, and I'm able to reunite not only with him, those instructors, and a lot of you students as well. So aside from all of that, the friendship, I couldn't be more blessed to have the friendship with this man as well, guys. And I'm grateful that you guys feel the same about how you feel about Tom and what he's doing. So what I'm going to do here with the Options Essentials piece is just take a few minutes to help a lot of our newer students go through some of the terminology and jargon on the basics of options here, so that when we get into the case studies, we go to the software and start navigating through it, they don't get tripped up on a lot of the jargon that may be coming their way. So for the most part, folks, an option is an agreement between you and the market. Who specifically in the market are you buying from, and who are you selling to? Don't get bogged down with that. You know, there are people that fill the role of a market maker that are obligated to take the other side of your trade. So you are basically, when you start, whether it is buying to start a trade or selling to start a trade, you are opening up an agreement. You are doing what's called a buy to open agreement. And that agreement on this option is going to stay open until you close it or expiration. Now, the two types of options that you have are calls and puts. The two things that you can do with them are basically buy and sell. Now, you guys can get as fancy as you want. You can buy and sell different options at different strikes and different expirations, all on the same order ticket. You can get as exotic and over inundated with the number of option contracts you want to put together in one trade as you want. But we're going to take the KISS approach and keep it simple, silly here, and we're going to just focus on buying calls and buying puts for now. Now, when it comes to options, they are deemed risky. Well, not by us for the most part, but you may have started out getting into options, telling people that you're going to come under this education, and they go, whoa, you better be careful, options are risky, you can lose all your money. Well, do you think with what's happened in the market this past week or since the start of the year, there's a case we made as to how risky stocks are as well now? So when it comes to the options, the reason it's basically deemed that is, for the most part, it's a fixed time instrument. These options have an expiration date. So you need to either exercise the right that you take with the option on or before expiration, or close the agreement on that option contract by buying or selling it back to the market on or before expiration. And what our education is going to do, folks, tonight and ongoing, and as you that have been with us for a while know, that we do what we can to eliminate or dramatically reduce the risk. It can't necessarily be 100% eliminated, but it can be dramatically reduced. And for the most part, when you think about it, options, the leverage that options provide is the fact that you can control X number of shares of stock with an option contract without the cost or the cash outlay of purchasing the stock to begin with, as you know. So when you hear about an option contract, whether it be a call or a put, one contract is the equivalent of 100 shares. So if you have a situation where you have a stock priced at $10 and you want to buy 100 shares of that stock, you see there that the cost is going to be 1,000, less fees and commissions. Whereas if you want to buy, let's say, a call option contract at a $10 strike for that same stock, and the contract is priced at $1, you're going to take that $1 times 100, and that's going to cost you $100. So in a sense, folks, what do you have at risk? On the stock, 1,000. On the option, 100. And you're able to participate in the move of that stock, whether you own the stock or you own the option on it. Now, for the most part, stocks don't expire. Option contracts do. So there's that risk again because of the fixed time investment. This thing has to do what you need it to do within a certain allotted time frame in order for that option contract to be profitable. That $1 that's shown there, the one contract at $1, that $1 is called the premium, or that's the price of the option. And when you look at option screens for calls, puts, or both, on all the number of different strikes that are available, you're going to be shown a quote for each of those options. And the quote consists of the bid ask, as you see there, the 90 cents by $1, that's your quote. That's the price that you buy and sell. Now, I'm not going to talk about buying in the spread or working the spread or shaving or all that. We'll just keep it simple here and just basically tell you right now that when you see a quote that says 90 cents by $1, if you're going to buy that option, you're going to buy at the ask price, the higher price. Okay, so you're going to spend the $1 per contract. What you're looking for this thing to do, this thing being the stock or whatever underlying instrument you're trading options on, you want that, in the case of a call option, you want the stock to go higher. In the case of a put option, you want the stock to go lower. The thing is, if you bought it for $1, you want the option to go up in price to $1.50 by $1.65 in this example. When you decide to sell that option back to the marketplace, you're going to sell at the bid price, that first number, the $1.50. So in that case, if you bought for $1, you sell for $1.50, you're going to make your 50 cents times your 100 shares for that one contract. That's your 50 bucks. Okay? It's a 50% return, by the way, not bad. So the goal, folks, on your options trading is to do this by expiration. And because they're American style options, you can exercise your right to buy or sell on or before expiration, whereas European style options, you have to wait until expiration. But the goal is to exercise your right to sell the option back to the marketplace before the expiration date, which is the close of market, the third Friday of the month of expiration that you're participating in. Now, for all intents and purposes, it's the third Friday of the month, even though it's technically the Saturday following the third Friday, but we don't need to bog you down with that much detail. Simply put here, guys, call options give the owners the right but not the obligation to buy an underlying security at a specific price called the strike price within a specific time, the expiration date. Now, the goal on a call option is to have the underlying go higher prior to expiration so that the option premium increases in price above what you paid for it originally so you can sell it at that higher price. And basically, call option means you're calling the stock away. You've bought the right to buy a stock at a specific price. And the strike price is the price that you and the markets strike up a deal. The opposite of that is a put contract, and that gives the owner of the put contract the right, but again, not the obligation, to sell the underlying security at a specific price, aka the strike price, within a specific time, which again is the expiration date. The goal on a put option, when you're buying these, buying calls or buying puts, on the put, your goal is to have the underlying go lower so that the option premium increases and that you can sell it at that higher increased price. Now, when it comes to the option premium itself, there's options pricing models out there. You can do an internet search and just go through all the mathematical gyrations and such that you want and look through all these formulas until your eyes cross. But for the most part, just focus on the fact that the two primary components you're focusing on with options is what's called the intrinsic value and the time value. The intrinsic value is the amount that the option itself is called in the money. I like to say where it has some built-in profitability. So when it comes to intrinsic value for a call, when your strike price on the option that you're looking at is less than the stock price, that's an in-the-money call option. It has intrinsic value. So there's the example right there. Your stock's trading at $47, and you're looking at a $45 call. That means if you bought that $45 call, you have the right to buy the stock at that 45 bucks. But the stock on the current market is 47. So if you were to exercise your right to buy it at 45, you have a built-in profit of $2 or intrinsic value of $2. Now, when you're looking at a put, there's a strike price, and if it's higher than the stock, you have an in-the-money put option at that point in time. There's your example below where it says the stock's trading at 47. If you're looking at a $50 put, there's $3 intrinsic value, meaning you have the right, if you bought this put option, to put this stock or sell this stock to the marketplace at 50 bucks. And in order to exercise that right, you would go out there and purchase the stock currently at 47 to sell it at 50. There's that built-in profitability of 3 bucks. That's the $3 intrinsic value or real value as they call it. And now whatever is left on that premium outside of your intrinsic value is your time value. And there are options that are 100% time value, and those are called the out-of-the-money options, and I got a slide for that here in just a second. But for the time value, that's basically just the amount of the premium that's not intrinsic. So there's your example. If you have that $45 call option with the stock trading at 47, and your premium is $2.65, out of that $2.65, $2 of that is your real or intrinsic value. And the time value is whatever's left over. $2.65 minus your intrinsic value of 2, and you've got 65 cents. Now, options are a fixed time investment, correct? Which means time decays. If that stock stays at the current $47 price and nothing changes except for a day goes by and another day goes by and another day goes by up until expiration, what's coming out of that premium of $2.65 is that time value. So, if anything, if that stock at least stays flat until expiration, you won't lose 100% of that premium. You'll lose the time value component of it, though, the 65 cents. You should be left with that $2 intrinsic value and at least be able to salvage some money, some preservation of capital at that point in time. Here's an example of the tools and what the options screens look like. You see your calls on the left, and you got your puts on the right. Down the middle of both of these sections is the strike price column. It intersects here with the stock price. What we're showing right there in the orange box is the stock price, $54.05. Over here, you're looking at the options symbol. What's highlighted with the orange box is the Microsoft February $50 call. Now it says Feb 16. That just means February of the year 2016. But this is a Microsoft February $50 call. And the quote that you see here is consisting of the bid and the ask is $475 by $490. So let me ask you guys, and maybe Tom pick me up and look at the Q&A board who answers. Are we in the money or out of the money? With the stock at 54, we have a $50 call. Is that an in the money call or an out of the money call?
I'm getting in the monies.
And that is correct. Now, the question is, how much are we in the money? If you're going to buy this option, you're going to have to buy it. Again, we're not going to talk about shaving or buying in the spread or using mid prices and such just yet. But you're going to have to buy this at $4.90. So if you are in the money, you're in the money by how much? You're in the money by $4 because the stock is $4 higher than the strike price. You have the right to buy this stock at 50 bucks. Now it's currently trading at $54. There's a built-in profitability. There's intrinsic or real value of $4.05. Now the market makers who you by and large, put your orders through. Yeah, you place them with your broker, but the broker, executes them through the market makers and such. They're just not going to let you take a $50 call off their hands and be obligated to, let you buy the stock at 50 and then sell it to the markets for $54. They're obligated to take that side of the trade. They're obligated to take that stock at 54. But if they give you the right to do that at 50, they're losing money. So they're not going to lose money. They're going to charge you at least that $4.05 in that option premium. So of that $4.90 there, $4.05 of that is intrinsic. So what's left over for time? Well, look at that column to the right of that box. It says intrinsic bid and ask. So if you guys haven't noticed this, even you experienced traders and experienced people with the tools, haven't recognized that, you're able to calculate, your extrinsic value as well as your in the money portion and such just by that. Just a little side note, little thing that I thought might be interesting to folks. Okay. So now,
hey Jay.
Next thing, yeah.
Can I take over for just a moment?
You want me to go back?
Yeah, I got some questions about the bid and the offer, and
okay.
What I want to do is let me grab the screen from you for a moment. And what I want to do is I just want to show people a couple of differences between something that's liquid and something that's not. So
there you go.
That way, because what you're seeing right there is a bid and offer. It's actually normal. What you're showing is actually a normal to even liquid bid and offer. So I want to just show everyone here a couple of different things.
And even when strike price up, the 5250s have a much tighter spread than 15 cents. I think it's like 4 to 9 cents even there.
Yeah, and so let me find my. I'm offline here. Let's do this. All right, you should see my screen. Let me log in real quick here. My password is a bunch of dots. Hope everybody got that. All right, so let's pop on over here to option chains for a second. Now check this out. We're going to run some option chains. The first thing I want to show you is you were looking at Microsoft, right? MSFT. So let's look at Microsoft for a moment. I want to show you a couple of different variances. So let's take a look at the options that expire next week, which is the third Friday in January. Then I want to come all the way out here and look at these options that expire in January 18. These are called leap options. So to do that, I'm just going to load these up real quick. And you're going to see all kinds of strikes right here for the options that expire next week. Now, take a look at this. This is open interest on the 50 call. There's 146,775 contracts that are open interest. All right. The other thing I want to mention to you is that you see the bid $255, the offered is $261, and the mid price is $258. So we're 6 cents between the bid and the offer on the options that expire next week. Now, slide down a little more. Let's look at the options that expire in 2018. These are 742 days to expiration. Unlike 7 for the first group I just showed you. Now, these options that don't expire for 2 years, take a look at the difference between the bid and the offer here. The 50 call is, the bid is $785 and the offer is $855. So we really have, this is a good, 50, 85, 95, 05, 15, 25, 35, 45. I mean, it's 70 cents. It's the 70 cents between the bid and the offer, not the 6 cents between the bid and the offer that we saw. So liquidity can differ in the exact same option. And what you need to know is the farther out you go, sometimes most of the time, the wider the difference is going to be between the bid and the offer. Now, is that something to worry about? I don't think so much. And the reason why is because up here, you're taking a 1 week position on Microsoft if you're buying a 1 week option. Down here, you're taking a 2 year position. So your plan is to be in this longer. This is more of an option investment with 700 days to expiration. And this is more of an option trade with 7 days to expiration. That's the first thing I wanted to show you. Now, the other thing you can look at with liquidity is you can find it in some places and not in others. SPY, which is the S&P 500. Now, take a look at the Jan 16s. Just going to show you the Jan 16s only. The at-the-monies are going to be the ones that are closest to the closing price. So the closing price is $191.92. Let's look at the 192s. 262 by 273. All right. Let's look at, and as you look, also if you look and you go out of the money, so let's look at the 195s, 128 by 135. Now, typically what's going to happen is these are going to get closer and closer together as you go farther and farther out of the money.
Yeah, 4 cents on the 197s.
Exactly. Yeah. And so, again, 7 days remaining before expiration. Now, I'll tell you something else, too. All the eyes were on the options that expired today. So I can tell you this, on Monday, you're going to see these options tighten up considerably because these are going to be the ones that everybody are looking at. Everyone's going to be looking at the options that expire next week on Monday. And then you're going to see these tighten up. And I've actually seen these options trade between 1 and 2 cents between the bid and the offer. In fact, I want to show you another really liquid one, and that's Facebook. Facebook is one of the most liquid stock options out there. And again, let me turn off all except I'm just going to look at the options that are within 10% of the range. And so that's just going to be 10%. 10% still a lot. But if you see the stock closed at 97.33, so if you look at the 97 calls, you see 244 by 257. And you might say to yourself, that's still kind of wide. When the market's open and the market is trading, all right, these tighten up considerably. When the market closes up, when we close up for the day, we're hitting 4 o'clock. Between about 3:55 to 4, they start widening. And the reason why they start widening in this case is that if you saw the markets this afternoon, volatility was extremely high. The higher volatility gets, the more nervous option traders get, and the wider bids and offers get. And sometimes when you're in the midst of high volatility, sometimes it's just best to take a breather and step back and let the market get volatile because eventually it will calm down. And when it calms down, you'll see these spreads come back together to where they're about a penny apart. So this is kind of an exception to what we've been seeing over several years. And that is that when volatility spikes up really high like it did today, we were up, we were up as far as close as 1970 yesterday evening. We popped back down to around 1930 on the S&P. Then we were back up to 1965, and we closed at 1913. I mean, that is huge. And you gotta realize that even stocks like Facebook and Apple, which typically have really tight spreads, are going to get wide when you have closes and you have markets that are affected by this way. Isn't that right, Jay?
Absolutely.
So let me pass this back over to you. I wanted to just show everyone a little bit of a difference between bids and offers. And the last thing I'll mention as you're grabbing the screen back, Jay, is that think of a bid and an offer. Who gets that bid and that offer? Well, realize there's a trader, an electronic trader now, but there are market makers who are very similar to auctioneers. And they represent both the buy side and the sell side. That means that we have a current buy price and a current sell price for everything that's listed on the exchange. And so, keep in mind that you can get instantaneous trade. All right. It just might not be at the price you want it at, but it's there. Imagine trying to sell your house and get an instantaneous price for it. Depending on what city you live in. I mean, if you're in Silicon Valley, you're probably getting your house is probably flipping over pretty quick. But if you're living somewhere else in the Midwest, chances are that your house is going to be on the market for several months. Realize that you don't have to worry about that in the case of options, listed stocks, because part of that market maker's job is to be a buyer for every seller and to be a seller for every buyer, so that you can get in and out of positions quickly. Jay.
Thank you, sir. Yeah, one other way that I learned it as well is as long as there is a bid and an ask with a number on it, you've got a buyer and a seller. If you get a zero bid by whatever, then they're not obligated. But as long as there's even a penny to 5 cents on there, as I understand it, they are supposed to take that other side of the trade for you. All right. So now what we've talked about here is in the money, at the money, or out of the money. Tom referenced it as well. He said at the money. At the money means that the stock and the strike price are pretty much the same number. In the money, for a call option is when the option strike is less than the stock. An out of the money call is when the option strike is greater than the stock. And for the put, it's just the opposite there. In the money, the option strike is greater, and out of the money, the option strike is less than the stock. Now, I used a term just a bit ago in reference to what could happen with the options, especially like when you buy them. When you buy a call option there, like you see that Microsoft February $50 call, you buy the option for $4.90. That gives you the right to buy Microsoft at $50 anytime between now and expiration. And what that means when you exercise your right to buy is you actually say, go get me the stock. That one contract or 100 shares, go buy me that 100 shares of stock at $50. Okay, so now if you spent $4.90 for that, right, and then you bought the stock for $50, your basis is like $54.90. And if the stock is currently at $54.05 still, that's not too favorable of a situation. What you want, and remember, the goal of buying a call option is for that stock to go higher. Say to $60. If that stock goes to $60, you're in the money $10. There's going to be at least $10 placed on that premium. So if you bought it for $4.90 and you can sell it for $10, you make $5.10. You double your money. Okay, so exercising is taking the stock. We are never going to buy options to exercise our right to buy stock. That is not the trade. That is not the goal. The goal is to buy the option, anticipating that stock higher. When it makes that high enough move that you now become profitable on that $4.90 purchase, you sell back and take the profits in. Then the other thing that could happen is you don't exercise your right, you don't sell the option back to the marketplace, and if the option goes down in value, say to $2.90, well then you could take a 50% loss. And sometimes options expire and you don't sell the option contract back to even take a loss, and then you end up taking 100% loss. So be careful of that as well. But again, in, at, and out of the money, there's the definitions, and for the most part, folks, that's going to wrap up the basics of your options education. I'm going to hand this back to Tom, and I think in just a few short minutes, I'm going to take the con back, and I'm going to go through some of the Tom's options tools, the actual website, and do some navigation with you all. So there you go, Tom.
All right, well, great. And all I wanted to do real quick was I just wanted to check the Q&A board to see if there's any questions on options. And we got a lot of partners in this room, and these are folks who've been with us for quite some time. And and the stuff I'm getting, guys. I mean, the comments I'm getting are fantastic. Happy New Year to you, Rhonda, and glad you're in here. Phyllis, who is in every single one. Phyllis and Steve. Is Steve with us tonight, Phyllis? Because Phyllis is even saying that she's happy to be in here on Friday nights. Let's get into some questions here. So we got what about open interest? So Jay, this is a question that comes up a lot, and so keep in mind that if you could let me grab the screen back from you because I see you're moving some stuff around over there. But
okay. You took it back.
Yeah, hold your screen open because that way I don't have to pass it back to you because I'm just going to do a little Q&A session here real quick. But how important is open interest? I can tell you this. I remember we did seminars. Jay, remember we used to pass out that questionnaire at seminars, and one of the questions was, what is the most important thing that determines the price of an option? Remember that? And it was A, stock volume, and it was B, option volume, and it was C, open interest, and D was the bid-ask spread. Do you remember that?
Absolutely.
And so the answer to your question about open interest is a really interesting one because there's a lot of times you'll see zeros somewhere like volume, and then you'll see this huge big number, and that's some institution. It's either getting in or getting out of a position. But realize that the bid and the offer are what make the most sense to me as a trader. And if you've got a tight bid-ask spread, you've got liquidity. It's hard to really look at anything outside of that to determine whether there's real liquidity there or not. But tight bid-ask spreads are the best way and actually the easiest way to get liquidity. How do you get out of selling it? Okay, here's a scary one. I knew we were going to get some of these. By the way, guys, I'm not going to mention names on here because if one of you are doing it, there's other people out there that are possibly doing it too. But this naked put thing, this is one thing you'll never, ever hear from me come out of my mouth or anybody else here at Tom's Trading Room is selling naked puts. Because here's the problem. You're going to be right most of the time, all right? And most people think that, they believe, the random market theory, that one day it goes up, the next day it goes down. I'll just sell out of the money options, and over time I'll be right 90% of the time. It's the 10% of the time that you're wrong. That's the time that it hurts, and it hurts you. It'll hurt you so bad. First, how do you get out of selling a put option? You reverse the order. You buy it back to close. All right. The problem is the psychology behind trying to buy something back when you're wrong. It gets really tough on you, especially when you have an open-ended situation. So let's say for a moment, and Jay, I am going to take back over the microphone, the channel here. I'm sorry, but man,
Okay.
I got to talk.
Lay it on him, brother.
This is some tough stuff. So I got to get in here and we'll talk about this. So let's fix the problem, and then let's make sure we don't make that we don't have that problem again, because this is one of those years where, let's go back 8 years for a moment, guys. I know it's an election year. I know market's supposed to go up, but I want to also tune you into the last time we had a president in office for 2 terms. Remember what happened on his last year being in office? It wasn't pretty. And is this happening again? We don't know. There's a very good possibility that could be happening, is that we're getting at what's called incumbent inversion, where the last 2 years of being in office for a 2-term president end up being negative. And if it is, you do not want to be on the naked put train, because that's a train that leads to nowhere. So with naked puts, buy it back. But let me just show you what we're talking about here. Here's an example. So let's say we're looking at SPY, and let's say we're trading the SPY, the Januaries. Now, I'm going to show you something that's really cool that we can do that nobody else that I know of can do, because no one else has this kind of data. No one has split adjusted data like we do. All right. Some people out there claim to have it, but they don't manage it properly. But I'm going to show you. We're going to go into the Wayback Machine, and we're going to go way back to January 4th. All right. And then I'm going to go ahead and update my back tested date for January 4th. Now what I'm looking at is I'm looking at an option that has 11 days to expiration. All right. So we're going to come on down and we're going to say, okay, so the S&P's trade at 20102. I know what I'm going to do. There's got to be some support here at 200, because that's a round number. So I'm going to sell that put, and maybe I'll collect $2.22. So let me sell one of those puts.
Hey, Tom, I don't see your screen back. I see Tom's trading essentials.
Shame on me. Thank you for interrupting me. All right, so let's start this over again. So I'm looking at SPY, and I'm looking at what I did was I actually went and I changed the back test date to go back to Monday, so we can actually watch this as it unfolds. All right, because I wanted everybody to get a taste of what a couple of folks that have sold naked puts out there have done. Mike, my brother Mike, don't do this. Okay, you're a newbie right now, and the greatest thing about being a newbie, Mike, is that you come to the table with no bad habits. so I'm going to show you what you don't want to do here. So on Monday, this January option, this is the S&P 500. All right, and it's an ETF, so it trades like the S&P 500, but you don't need 2,000 points or $2,000 to buy a share. You can actually buy a share for $200. But naked puts offer the ability to actually get into a stock cheaper than where it is today. All right. And so by selling a naked put, what you're doing is you're obligating yourself to buy this particular underlying at that strike price if you are assigned. All right. And the only way you end up getting assigned is if the stock comes down and actually goes below this number. Because if it goes below this number, what it means is that the S&P or SPY is actually trading for less than 200. So somebody's going to be happy to take this off of your hands. If it's higher than the actual price, it actually makes it advantageous for the other party, the buyer. But if we sell this, and I'm going to -1 this to sell it, let me show you what ends up happening. You're going to sell this, you're going to bring in some premium. Now, a lot of people do this because they believe that the probability is on their side. And you know what? I'm not going to disagree with you. But the thing is that the markets are not like, this isn't like Las Vegas. Okay, Las Vegas, when you roll the dice, there's a mathematical probability that certain numbers come out each time. All right. In the markets, we're dealing with fear and greed. There's not a mathematical probability. There's a statistical probability that stocks will stay in a range, but fear and greed are what ultimately drive the markets. All right, not the roll of a dice. And so that's one of the reasons I don't believe in market randomness, because if market randomness really existed, the market would stay the same all the time, go up a little, down a little, but it just doesn't do that. What happened in August? That was anything but random. What happened last week? Anything but random. Now, we could bring in a credit. If we sold this option for $2.22, we would bring a credit in of $222 on the contract. All right? So this is what your risk graph actually looks like. Here's the trade, here's the market kind of bouncing around, and it's come down, and you might have this great idea that, wow, I can sell this thing, and as long as the market stays above 200, within 11 days, I'm going to make this money right here. If the market goes up, I make money. Here's what happens, though. If the market goes down, your risk graph shows you now where you are and losses. All right? So where did SPY end up closing today? It actually closed around 192. So if we put us on the 192 on the graph, and I'm going to move up a little bit here, this is pretty close right here. This is showing that your $222 potential profit is right now a $634 roughly loss. And I'm going to show you how that unfolds. All right? Because here's the thing. When you sell a naked put, you do take a credit in. And we have probability numbers on here. Come on down. You can see them. Here we go. 68% chance that you're going to get an expected profit of 5 cents. All right. I got to tell you something. That doesn't excite me. I get a 68% chance. Listen, if I'm going golfing, which I probably am not, but let's say I go golfing. I live in Florida. Everywhere you turn is a golf. There's a golf course. If there's a 68% chance of sun, and there is a 32% chance of rain, I'm not going golfing. You know why? Because I know in Florida, a 32% chance of rain means it's going to rain. And so, when I look at this, I look at the same thing. There's a 32% chance that this is going to end up not working out. And so you might say, oh, yeah, but I could sell all the way down here in the 190s. Let me tell you something. If you sold the 190s, you wouldn't get hardly anything for them, number one. And number two, with the S&P now barreling down around 191 and change, you got to be worried going into this weekend, and got to be praying that China isn't going to pull something, another stunt, another surprise. We're going to wake up Monday morning, we're down another 300 points. So here's the thing. This risk graph represents a lot to me. It shows me a little bit of a gain on the upside, and it shows me a lot of loss to the downside. That's why I don't do naked puts. And if we follow along here, let me just show you what happens. Let's go plus a day. So I'm clicking on the plus a day area right here, and this is going to change as the market changes each and every day. So now it's showing 1 day later. Well, our puts didn't lose any money. Didn't gain any money, but they didn't lose any money. So I see $222. Actually, I see a small profit of $41. Look what happens on the next day. So I click this thing once again. Now we're down $75. So things have changed, all right? And you can see the risk graph has changed a little bit. The market's come down a little bit. How about the next day? Now we click it again. We're going to move forward another day. Now we're down $460. Guys, this was Thursday. Down all of a sudden, my $222 profit I was looking for, I'm now down twice as much. I'm down twice as much as I possibly could have made. And you can see the market's dropped, and you can see this is where I am right now. This blue line over here represents where the market is today and where you sit on the P&L graph. All right? Want to see what happened today? Let's go ahead and click on latest. Latest will take you immediately from wherever you are to today, and you can get an idea. Did it get worse? Well, let's find out. It's calculating, and yes, it did. $577 of loss. And so again, if you're in a position like this, to me, if you gotta trade naked, at least give yourself a time to get out. And your time could be, get out, maybe trade weeklies. That way, at least at the end of the week, the thing pulls you out, win, lose, or draw. Stop losses. That's another important thing. Now, I want to show something else here. And this is on our forums. So I want to show you our trader forum. And we've got a message here that came in today that, example, buying $10 puts for 32 cents. Now they're trading at 6. The shares are trading 5 points out of the money with $15 with 7 days to expiration. All right, is this a good strategy to sell an equal number of 14 puts at 50 if now I believe the stock will expire 7 days at 15? My net cost would become 500 minus 320 is 180 per option with a $320 loss letting the put expire. Is there a better approach that might protect the swing in this market? Now, the great thing about our forums is we got a lot of smart people in here, and Davis, who actually happens to be one of our members who's been around for a while, had some really good answers in here about buying puts, selling puts. And, the number one thing, obviously, when you get high level is you need a trading plan. And you need to ask yourself, what was the reason for getting into this trade? We all ask ourselves these things. What are the reasons for getting into these trades? What is my target? If you don't have a target, can you imagine not having a target when you go hunting? I mean, what are you doing there? If you're going deer hunting, your target is deer. If you're going elk hunting, your target is elk. But if you go out and you don't have a target, you know what you're doing? You're wasting time, right? And probably distracting the other hunters. They end up might shooting you. So, look for a target. Also have a stop in place, unless your stop is the actual option or option spread. A lot of times when I put trades on, if I put a spread on, my stop is the spread because my spread is fairly conservative. All right. We're going to talk about spreads next week. So let's just focus on the example here. For me, I've always thought this. If when in doubt, what is it? Get out. When in doubt, get out. All right. So for anybody who suffered through this weekend and kind of saying, "Wow, I don't know what to do." Well, if you don't know what to do, then probably you didn't have a trading plan on to begin with. So if you go in without a trading plan, then it doesn't shock me at all that you may be in a situation where you're saying, "Wow, what do I do?" Okay. There's two problems that come with losses. Number one is not having a trading plan, because then that leaves you in the unknown. Listen, I got to tell you guys something. I took a loss earlier this week on something that was a very highly leveraged instrument. But you know what I did? I got in. Well, I'll tell you what I did. So last week I had a pattern in the market, which was the final 2 days of December. And so that was a particular seasonal pattern. Worked great in around Thanksgiving. Then came Christmas. 2 days before Christmas, this trade actually broke even during Christmas. I thought, all right, I'm going to get them right before New Year's Day. And of course, New Year's Day, the pattern went down. Let me tell you what I did. The smart thing I did. I got out at the end of the day before New Year's, because you know what would have happened if I had sat in that thing come Monday? Would have been a lot worse. Would have been a lot worse. So, first, number one, have a plan. Number two, stick to your plan. And number three, be real careful when it comes to allotment of capital. That's what I like to do, is that, I allot a certain amount of capital when I do my trades so that I don't have to worry too much about what's going on. I do at least one webinar a week during the market hours. All right. We have a trading room for our professional traders, and we do this thing. We do the trading room during the day. And I got to tell you, if I had too many positions on that were too expensive and had too much risk on them, I'd have a tough time this week trying to teach in the last 2 hours of a trading day, let alone actually trade in those last 2 hours. So make a plan, work your plan, and watch your money line. And that's my big things I can tell you. Now, when it comes to taking a position and trying to work your way out of a trade, we have some ways of doing that, and that's going to take much longer than I have right now. But I'll tell you what we will do is that this might be the perfect time for maybe a session next week. And what we'll do next week is I will open up, because I wasn't ready for this now, but I will be ready for it next week. We're going to do a little 911 CPR on stocks and on options. And I'll show you a couple of them that you can do fix-it plans on. All right. But sometimes the best fix-it plan, I'm going to tell you this right now, is just getting out of the junk that you're in. And then tomorrow's a new day. So
clearing the head and starting over.
Yeah. I mean, you know that, Jay.
Yep.
So let me turn this back over to you. So you got a couple case studies we're going to be working with, and so I
We'll
will.
see how they work out.
You ready to take this thing back, there, my friend?
Yeah, I'm going to go ahead and be on the Tom's Options Tools website when you get me back.
All right, handed it over to you right now.
There we be. All right, just let me know if you see the
I do.
Tom's Trading Room screen. Beautiful. Now, when you guys log in, depending on how many of our mastery coaching trainings you've taken or not, you'll see the various buttons that are available. Even if you see the buttons and you're not able to click onto them, that will come as you progress through your education and you want to go ahead and focus on a particular strategy over another. So you want to get really good at butterflies, you really want to get good at spread trades, like one of our instructors, Devin Pearsall, teaches with the layered credit spread strategy. Those different buttons will open up to you that coincide with the education that you've taken. But you guys will see the different functional buttons that we have for subscribers for our what Tom calls his modules, like Darknet and the Money Calendar. And then you'll have the weekly newsletter over here, which I think, Tom, you've got the newsletter up and all ready for tonight?
Yeah, I do for our tools members. It's out there. You can click on the little blue button once you log in, and you'll see that newsletter, which is really just a nice big market outlook of a lot of details of what I've done. And I'll send a link out to you to all you guys, all of our members later tonight, so you can just click in right from there.
Okay. Well, we're talking about buying calls and buying puts. And, the module Darknet is a great buying calls tool. If you want to look at opportunities to buy calls or buy puts, Money Calendar could be another tool that is beneficial to you. Let's go ahead and just do some basic keystrokes on the Money Calendar. And what I'm trying to do is just find a candidate or two to look at that shows, a stock that has a propensity to move higher or move lower in price, and has shown the propensity to do it at a high percentage success rate over the last 10 years. Once we find a couple of candidates there, we're going to bounce out of that and go right into the options tools and use one of the features and one of the searchers that are located up here in the searchers tab and under the multi-strategies called Find Trades, and we're going to look and see if we can find some options that, based off the calculated expected move, could potentially double in value. So first off, let's click on the Money Calendar, and we're going to click on the View All Markets tab, and you're going to see a color-coded representation of the month. So here we are for January, and the darker the shade of green, the more bullish candidates versus bearish candidates. The darker and even into the red that you may see on upcoming months indicates the more bearish candidates over the bullish. And we used to just color code it, but we've had some people that have discussed a color blindness kind of effect where they can't differentiate the green from the red, so we put the numbers in there. So you see, let's go to January 11th. Right now you see 36 total candidates, 15 of them are bullish and 21 are bearish. And we're going to click on that, and it's going to bring up the list of the different stocks. It's going to show you the green bar if it's a projected move higher. It'll show you a red bar if it's a projected move lower. And for the most part, guys, on the Money Calendar, what we're looking for with this module is, again, looking over hundreds of millions of data points over the last 10 years. We're going to see out of that high liquidity stock list, which of those have proven to make an upward move or downward move, 9 or 10 out of the past 10 years. And not only that percentage success rate are we going to look for, we're going to look at what the average profit move over that specific date range was. And what do I mean by date range? Well, you see January 11th is the date that we're on, and that's this upcoming Monday. And then from January 11th to the end date for, say, Netflix here, its end date is February 17th. So between January 11th to February 17th, it's made an average 6-point move 9 out of the last 10 years. What I want you guys to do is double-click the average profit column heading there twice. The first time we'll rank them with the lowest average profit move to highest. The second one will take it from the highest to the lowest. And again, you'll see a mixture of green and red, which means stocks poised to move higher, stocks potentially poised to move lower. And the one we were focused on looking at here was Citigroup. And real quick before I get into the options analysis, if you click on the ticker symbol, you'll see again a recalculation of the data you've seen on that previous page where it says buy and sell, January 11th to January 16th. This batch of information right here shows again the trade duration, average trade, and the accuracy, and then you see a 10-year bar graph here that if you put your cursor on each one, it'll show you the average profit move for that particular stock over that date range. One last thing, if you click on the bar, you'll get a candlestick chart representation of that 6-day move as well on each year that you click. Okay, so if we go back to view day, let's go ahead and do average profit, click it twice. You find one that you like, Citigroup. This is going to be a very quick one. If it happens, it's going to happen over 6 days. Now, has Citigroup been dropping already? Yes. Will it continue to drop? Possibly. There's, even though it says 100% accuracy, it doesn't mean that the next trade is going to work. And even if it does move profitably, but it doesn't move the same 48 points, what if it only moves 24 points? Was that a failed trigger or a failed signal? No, it was still profitable. It just wasn't as profitable as the average move. So now, once you have determined which stock you want, and folks, a rule of thumb while I click on the options tab up here, again, put your cursor on options. When the drop-down menu or cascade menu populates, click on option chains. I typically won't look at stocks that have an average profit move of, say, 2.5 or lower. Usually, I'll even move it up to 3 or lower because it's going to be hard to find an option that's going to double with, an 80-cent move in the stock, or a $1.25 move in the stock, all right? So we decide on Citigroup. We go ahead and bring the option chain up. And over here under controls, under the stock symbol, let's go ahead and click in that box, take the existing symbol out of there and type in the one that you want to look at, in this case, C. Click update. When you've clicked update now, you've asked the tools to look for the different expiration months for Citigroup now. Now, which options expirations do you want to look at? You can click on the different boxes over here if you want. And if you don't want to look at the January week 4 or the January week 2, but you want to look at January 16, just click the ones that you don't want. It'll take the check mark out, and then click on update again, and it'll reset you. And down below, you get your options page layout like we've shown you in the previous slide. Now, the question is, or what I was talking about, is you look at the money calendar, you see the average profit move, and you see the end date that is expected to make that move. If you can't remember it all the time, I would suggest writing it down. So Citigroup was looking for a $7.91 move to the downside, I believe. And do you recall the end date for that? I believe it was January 16th. Okay? Now, just have that information written down off to the side, if you will, because when we go ahead and do this analysis of the options and seeing if there is one that can double in value with that price move and within that time frame, that's the one we may hang our hat on and take as an actual trade. Now, as Tom stated with the disclaimer slide, we are not registered investment advisors. We cannot recommend that you take the trades, but we sure as heck can educate you on how to go through the process to find opportunities to then let you decide if, hey, Citigroup can double with this price move within this type frame. That's the option I'm going to go with. Who are we to stand in your way to go make that trade, right? But now we're saying we want to see if there's an option that has the capability to double. So here's what I'm going to show you. You may have seen different ways and different searches within the tools as to how to find, the double information, like through the double finder. I'm going to simply show you this. Put your cursor on searchers. Put your cursor on multi-strategies, and then left-click on Find Trades. Here's your Find Trade screen. If you want to click on the Help button, you can do that, and a different browser window will populate, and it will give you an educational tutorial on all the different functionality that this page provides you with screenshots, images, and text. All right, so now we have the stock symbol. It is C, that's Citigroup. That's what we want. Our market outlook, are we bullish or bearish? We are bearish. Now, implied volatility, I didn't get into implied volatility on the basics of options because this is where people's eyes get crossed. You can read up on implied volatility on your own. Just recognize that if you have an option that has a high implied volatility number, that as it's an options pricing component, if it's a high IV, options are deemed a little bit overpriced. Now, as you learn more about it, you can decide to incorporate high IV, low IV, and what measurements are too high for you to take a trade or not. Or you can do what Tom has educated me and many others on, is look at analysis and strategies that don't need the IV analysis. And that's what Money Calendar provides us. Because nowhere in the back 10 years of the calculations from Money Calendar were they adding in an IV component, or an envelope channel component, or Morningstar reversal off candlestick patterns components. Folks, Money Calendar, Darknet, all the other modules, this one is sweet in that it's purely price, as much about price as anything else. What stock has made a move higher or lower at a 9 or 10 out of 10 times rate, and what was the average profit move on those runs? And trust me, we've gone around the block with a lot of our members, subscribers, and partners and such, that if Money Calendar, in this case, or Darknet finds a candidate, they'll say, but the 10-30 moving average has a death cross, or it's breaking below support. And that may be true, and that may talk people out of taking the trade, but that's not what Money Calendar was calculating. It's looking at the price over the years and the average price at that and the time frame it took to do that. So we'll leave the implied volatility low, and then we will select the less than 45 days. Why? Because Money Calendar showed that it was going to happen in 6 trading days. So I don't need 45 days or greater to look at, okay? Next, what you're going to do is under option strategies is click which option strategy you wish to employ. Based off your market outlook and implied volatility, it gives you the trading strategies that you can employ. We're going to click on buy put. Now look what happens over here in your selected strategies box. The buy put strategy automatically populated for you, and the trading sort method. And what that means is it's kind of ranking or looking at the options based off a bearish percent to double, meaning a low percentage stock price move for that option premium to double. Let me ask you, do you want this stock to have to make a 100-point move to double, or would you be happy if it only took 2 points to double? For the most part, folks, you want the lowest price move as possible. So in a sense, it's like the great American way, right? You want to work the least amount, make the most amount of money. So you want your stock to make the lowest, or smallest price move possible, but yet still get a double out of the opportunity. So once that is all done, let's go ahead and click on search. And you'll do this every time. You'll just type in a new ticker symbol. You'll click change. It will refresh the screen. You put your market outlook bearish and your implied volatility. You'll select your strategy, and it will default to the percent to double for you. So here are the various options. The January 15, not of 2015. That's the January 15th. That Friday's date is the 15th of 2016. It's a put, and the strike price is a 46.50s, and the price of the premium is 144. Okay. Now the next one is a January 46 put for $1.20. And you see a bunch of other columns over here to the right: max risk, probability of profit, odds, open interest, and such. When you're looking at these, Tom tends to favor, and he's taught me to favor on these very short-term directional trades, to favor the shorter term in the money options with about a 70-75 delta. Now we don't have that information on here, but when you see these strike prices, I'm usually looking at with dollar strikes, I'm looking at about the $1 or $2 strikes that are in the money, or even at the money to start. Okay, and for the open interest, there's 1178 on the 46 versus 273 on the 46.50s. we can look at both, guys. We don't have to just start with one and say, if that one works, great, that's the one I'm going to take. Or if that one doesn't work, I'm not even going to look at any more. Let's just go ahead and pick one, okay? So when you pick one, now on my laptop, it opens in a new window. Sometimes on yours, it will open in a new tab on the existing. But here's the separate window now. And this is a risk graph plus view. For those of you that are asking the difference between risk graph plus and risk graph, this one just works better for the higher resolution laptops. Here's Citigroup. Here's the options information. Your entry debit is $1.20. Look at this row of information here. You've got your leg date, which is today, the position, whether you're buying or selling. The two columns that allow you to change the information is your numbers, which means the number of contracts, and then your entry, which is your entry or purchase price for this put option. And what this does, if you're using, the mid price, is it will show you the bid and ask is 118 by 122. The mid price, or if you were to shave or buy in the middle of that quote, and you can pick it up for $1.20, then you save a couple of cents, which means a couple of dollars, and over the number of contracts that you have, it could add up to quite a bit. But now this entry price, 120, is what is your entry debit up above. Remember, one contract is the equivalent of controlling 100 shares. So $1.20 times your 100 is your $120, and that's your cost to enter this trade. Okay? Now, I'm going to leave it at the number of 1. You can change it to whatever number that you want based off your trade and risk management rules. Now, the thing is here, we looked at a column of information that said percent to double, bearish percent to double. Where is that information here? All the way down on your screen, you have your statistics and probability box, and in this box down here at the very bottom, your days expiration, probabilities expected and such, the far right is your percent to double. So this shows you how far of a percentage up or down this stock has to move, and at what stock price this option will double. And it shows you the red, blue, green, and black time intervals. The red is from now until expiration, and then it breaks it out quarterly up until the black, which is the 0 days left or on expiration day. So based off options pricing models and times to expiration and such, you'll see these numbers differ slightly. If this thing was going to move right now, today or Monday, it would have to move down 4.3% to 44.16. If it's going to take a little bit more time, and you have to wait till the worst case scenario, which is the day of expiration, Citigroup has to be down 5.4% or at 43.65 for that option to double. Okay? Now, let's go back up here and look at something. Underneath the options information, you have two visual images. One is the chart, and the right is the risk graph. And the red, blue, green, and black coincide with the red, blue, green, and black from that box down below. Each risk graph line represents where the stock is, at what time frame before expiration, and then you can coincide that with the profits down below. If you're on the modern risk graph, the classic risk graph may look different, where the profits are on the right, stock price is on the bottom. But just do your intersection as to where the stock is, at what time interval, and when you put your cursor on these lines, it'll show you the profitability of that option at whatever stock price. So real quick here, guys, what was the expected price move down? $7.91 on Citigroup? Does this stock, with this option selected, the January 46 put, need to move that full $7.91 to double? No. Now you can calculate out $7.91 lower from the 46.13. You can put that information into your stock limits box, refresh your risk graph page, and see what the value of that option will be at that money calendar price. But the tools are telling you that this stock doesn't need to work as hard as that $7.91. It only needs to move to $43.65. So what I do is I look up here at the closing price, $46.13. $46.13. Now, who is a calculator? that can look at 46.13, subtract the 43.65, and tell us how many points that is. Anybody figuring it out faster than me, Tom?
I'm looking 248, 248.
That's what I got. Yeah, it's 248 lower. Now, you can go ahead and say, look, I'm going to put this trade on and expect the 791 lower and make a whole bunch more money than just a double. Or you can be happy with the double and with the tools calculate now what percentage and more importantly, what price that target that stock needs to hit in order for the option to double. You like that?
Good stuff, Jay.
So again, huh?
Good stuff.
All right, yeah, just a 248 move lower, guys, and this thing has a chance to double. Now, it's shown that it can move more than 248, correct? Now, Tom, we're at risk of showing this chart over here because people are going to say, well, what if we get a snapback rally? What if we get an oversold bounce? And, you know, what does certain indicators say? Is this on support? Blah, blah, blah. You can do all that if you want, folks, but remember, you're risking talking yourself out of the trade. Stick with the calculations provided by Money Calendar, and the only deviation from Money Calendar that I offered you is to look at the percent to double, because you may find that if your target is a double, it may not have to work as hard as the average profit move was calculated. Okay, so now if you like this, you can go ahead and click Save in a specific folder. You can write it down. You can go to your actual brokerage account, place your trades, and do whatever you would like to do. But for the analysis part of it, folks, that's the process. And if you don't save this, you want to go look at another one, then just click X and close out that window or close out that tab, and you're back on this screen. You can go through the process again by clicking on, well, let's just see what the 47s look like. It brings it up. Scroll back down to the bottom again, and get what that percent to double number is. 43.57, not too far off, right? About the same. So dollar strike difference is about the same, you know, percentage move needed.
Awesome.
All right, so
Jay,
that takes care of the group. Yes.
Let me take the next one.
Oh, you want the next one?
Yeah,
you got it.
I'm going to try to, I'm going to try to act like my brother Mike for a moment. Actually, I should make him take it, but we didn't plan for this, so I'm not going to put Mike on the spot. But you know what? Let me try to act like I'm going to have you kind of walk me through this real quick using what you just said. So we'll make this one a little quicker since we're running out of time. But okay. Let me grab the screen back from you. I'm going to do that right now. So now what I've got on here is I did my work and I find Disney. And so, somebody asked, they said, well, with all the market volatility right now, doesn't that kind of throw this out the door? And, the answer could be perhaps, but, we had volatility back in August. We had volatility back in September, and we fared pretty well, and so what I find is when volatility goes up, there are two things that need to happen with not only this type of strategy, but every strategy. And that is, number one, is that you really got to balance out your bulls and your bears. You try to be more portfolio neutral. And then the second thing is that you got to start cutting risk. You want to try to cut your risk down as much as you can. So we're going to talk about one of those right now, which is looking at, I try to look for like a bull for every bear. And then the second thing we're going to talk about is cutting risk, but we're going to save that for next week. So I got Disney here. I'm looking at it, and I see that we have a trade that starts on January 11th, and it ends on February 13th. All right. Am I in the right date form, or should I be looking at Friday? What am I looking for?
It should be Jan 11th.
11. Okay, so I was right. So I'm clicking on Disney, and I like Disney. And I'm thinking, I'm trying to keep I'm trying to keep the fact that Star Wars is probably going to be one of the biggest blockbuster movies of all time out of my head. I'm trying to not think of those things. I'm trying not to think that consumer confidence is up, and that's going to help resorts and Florida's seeing a renewed interest in tourism like never before. I'm trying to not think about all the fundamentals. I'm really just trying to think about this area right here. And this January and February. So we have a January 11th to February 19th. We see that. I also see that even though the average trade is 244, I'm looking at this chart here, and I see that in 2011, 12, 13, 14, and last year, this pattern that happens during that time frame seems to be bringing in more and more money. Now, is that because the stock price has been going up? Probably, possibly. But you know what? When I look at last year, it made 992, and I look at 555, and I look at 328. I got to lean toward what's been going on. Even though the pattern is to the upside, I'm really wanting to lean into what's going on here over the last few years. So at this point, I'm going to come up here, and I'm going to go to options chains. Where do I go, Jay?
Where did Jay go? I was answering a couple of questions. I apologize.
Oh, you know what? Yes, I keep forgetting that we're doing two things at once here tonight. But I could go to
option trades. Yep.
And I could go to now. The other thing that I got to realize is that this went all the way out to the end of February, so I really need to be either looking at the last week of February week 4, or I need to be looking at March. And so let's take a look at February week 4 first.
Now, this is a little bit more of the longer way, and I brought this up when I did it, but really, once you have the stock and the average profit move and end date run from money calendar, you can go right into that fine trades. But if you want to do it, a little bit different and a little more lengthy way, this is what we're doing here.
Yeah, I'm showing someone how they could do it even on their own broker's website, because all you're really looking at here is options. Anybody can do this. So,
yep.
So from here, I've got 99.25. Let's round that up to 100. If I'm really looking for let's even call it a 5-point move, then I've got 105 as a target. Well, I don't want to sell I don't want to buy the 105 calls because I could actually lose even if we go to 105. So I want to be looking at something that's closer to where we are right now. So I see the 100 calls. They're out of the money. All right. They have a higher, their volatility reading is at like 28, which is a little bit more than they're used to being. I would venture to say there's probably a good maybe 20% bump in implied volatility this week on Disney. So that means that these options cost 20% more than the same ones with the same expiration, say, a week or two ago. But if I were to go in and buy the 100 calls, and I'm just checking this real quick, they're close. This yellow area here shows me that the percent to double is lowest if I actually look at the 101 calls. But if I look at the 100 calls, they've got a small amount of volume, but 65 by 95, 30 cents on a day like today is actually pretty liquid. This is only going to contract if we get a slowdown in volatility. So let's look at 380 as an example. So I get 380 here. I'm going to click on my risk graph. And we have a difference. I had somebody ask, what's the difference between risk graph and risk graph plus? And I actually had this the other day. And the difference is that, we have a risk graph, we have a risk graph plus. Is that like a super risk graph? No, that's a risk graph for higher bandwidths. So we have a low bandwidth risk graph, and we have a high bandwidth risk graph. If you're using like a cell phone, 4G, that kind of move, risk graph. And then if you're using like high-speed internet access or you're plugged in direct, then you go with plus. Anyway, here's what we got here. So this is a call option, and it's showing me if we go back to 105, what do I stand to make at expiration? And I see that I stand to only make, check this out, Jay, really only going to make about $150 profit if I'm using my target of 105. That's not so good. Especially if it costs me $360. I don't want to risk $360 to only make $100. It makes no sense at all. So
it's like the guy at the horse race track that walks up to me as I'm going in the gate. He says, "Well, however much money you got, give me half. That way you can go home with half your money."
Yeah. I like the one remember Vegas Vacation? When Chevy Chase strolls up to the blackjack table, and he's got his wad of money there, and the guy behind the counter, the dealer, looks at him and goes, "Hey, tell you what, how about you give me half the money you were going to bet? Let me kick you in the groin, and we'll call it a day." and it upset him, and he started getting, he started throwing money away after hand after hand after hand. But I cracked up when I saw that position, because sometimes, I mean, I cracked up and then I thought, ooh, that reminds me of myself long ago, before I started becoming a rules-based trader. When I used to think something was going up or think it was going down, kind of felt the same way. So anyway, I'm leaving this here because the money calendar in this case is showing us a bullish trade on Disney, and it might work, and it might not. All right, 90% the last 9 of the last 10 years, this pattern went up between now and the end of February. However, it might not go up enough in this case. Maybe we got the wrong strike. Maybe there's something we could be doing that's a little bit different here, because perhaps volatility, which is down here, it's not extremely high. Here's your volatility that's happened. Here's high back in August and September. Here's where we are now. Not extremely high, but yet not extremely low. So is there anything that I can do with this particular position when we move forward? And so this is the point where I want to stop right now. And Jay, we've got some homework for these folks that we'd like to so let's do a quick little summary. And let's see. I'll bring up. I got the homework assignment over here somewhere. I think I do. I do have the homework assignment. So I've got it right here. So what we're going to do is, I'd like you guys to, first of all, I'd like you to find what you feel is your best call or put option trade on the following. All right, Citigroup, and what Jay did was he showed you a bunch of different opportunities. I want you to find the one that you think fits your personality, okay? And be ready next week to explain why. All right, with what? With the option, the cost. All right, where your profit potential is. What's your risk? Okay. And then Disney, and I showed you an example. It didn't look like a really good example, but it was an example. And the next question I want you to do is, I want you to say, can you make the trades in question one better? And how would you do that? Okay. And maybe you take a different month of expiration. Maybe you take a look at a different strike. Or maybe you do something that we're going to be talking about next week, which is spreading the options. All right. And I got an extra credit piece of the homework assignment here for you, too. I want you to use the money calendar for January 15th. And I want you to find your favorite trade for January 15th. That's next Friday. We're going to be back again next Friday. And what we're going to do is we're going to review all of this before we begin what we're planning on doing next Friday. We want to review what we're talking about here: a call, a put. We're going to review Citigroup. We're going to review Disney. We're going to review the money calendar. And we're also going to see if we can make these trades any better, all right, to try to find the best trade that fits our personalities as traders, all right? Finally, I want to mention this, because there's a lot of you, most of you on here are using the tools that are on Tom's option tools. But for those of you that are still kind of kicking the tires, got something for you. And this will definitely help you in this homework assignment, especially question 3. So what we have for you, I want you to take a look at this, is that at the top, when you log into Tom's option tools, you'll see a little area that says 7-day free trial. And we have a 7-day free trial. You just have to click on that, and you can sign up for it at tomsoptiontools.com. And what I want to do is I want to actually give you the link. Jay, can you put the link in there for everybody? The HTTP and everything, all that stuff. All right, HTTP:// and then www.tomsoptiontools.com. So it should look like what's on the screen right now.
Yes, sir.
Okay. I'm going to put that in because I want to show them what this actually looks like. I want to show the guys what you can expect to see. So if I put this into Tom's option tools, all right, and then you're going to go over here to the upper right-hand corner, click on the free trial. This is going to take you to a couple of different specials we're running for the new year. And this is something we call our option trader, which is just options. You can see all the different things we do with options. It's really nice. And you got a little what you get here for this particular package. You click on that, it drops down and shows you what we have. We have contrarian trader. We're actually going to do a little bit of work with that next week. All right. And that is I call that the way of trading Elliott wave without the counting. All right, we'll show you that next week. And then this one we talked about the money calendar. And so this one actually includes, Complete Trader is option 1, option 2, and option 3, which includes the money calendar. And then we've got the professional trader out here, which we're not going to get into in this session, but you're welcome to try out any of these. If you click on your free trial, then you're going to have to go through. You have a terms of service you got to go through. You're going to put your information in here. And then you're going to, down at the bottom, you're going to create your own username and password. All right, this is something we just started recently. And then first 7 days are free. And then after that, if you want to continue with us, then you can continue with us at our reduced rate that we have for the new year. All right. And so there you go. And make sure you put that CAPTCHA stuff in too, because it won't work without that. Jay, my brother Mike actually signed up for this. It wasn't that hard for him. He was able to do it. And he has a PayPal account.
Mike can do it. Anybody can do it,
right? I didn't think, yeah. Hey, Mikey, if Mikey likes it, everybody does. Remember that commercial? Hey, Mikey likes it. I think it was a cereal. I don't remember which one, though. But anyway, sign up. You get your first 7 days for free. Listen, if you cancel, and you can cancel at any time during the 7 days, you don't get charged at all right? But what we want you to do is try it out and use this. Use this for the homework assignment that we have here, because when we come back next week, guys, we want to see a lot of engagement in this homework assignment. And I think what we're going to do is I'm going to get in here extra early next week. Jay, how about you and I come in here about 15, 20 minutes before and go ahead and start the webinar? We won't do the recording, but we'll start the webinar, and we'll do a little teachers in session where we'll answer questions for the first 15, 20 minutes before we start the session. What do you think of that?
I like it. I
think so too, man. I mean, it's,
Are you going to put discussion boards?
I have nothing better to do with my Friday evenings. So how about you?
All you can eat seafood buffet, but I'm good.
That's right. And those of you guys that have tools, that are tools members, take advantage of the traders forums. All right, because you have the traders forums there. You can post up your trades and your trade opportunities on the traders forum. You can actually even put in the pictures too, so you can actually throw those up there, and then we'll go through the traders forum too, and we'll pull your questions and opportunities right from there, your case studies, and we'll use them as part of the class. So that's the plan for next week. Jay, any closing comments that you'd like to make?
No, other than that, just thanks for allowing me some stage time, and look forward to continuing on so long as you guys will allow, and look forward to next week's session. Awesome. Especially about these toms I like, because when we've started having people put stuff on the traders forum, it becomes now an arena where you and I are like the teacher, the instructor, the mentor, they're the student. Eventually the learning curve accelerates, they get to the point of proficiency, and they become more and more like trading partners, and we have extra eyes covering the market now for opportunities. So we really get to benefit and help each other out in that regard. Right.
Absolutely correct. And I want to also make sure that that everybody realizes that the stuff that we're showing you tonight, when it comes to options, every broker's platform has the option premiums, has the strikes. They've got the option chains out there. You can get the option chains from anywhere. You really can. You can even pull risk graphs on a lot of these. I can't imagine a group that has that doesn't have risk graphs. Can you, Jay? I mean, most of these brokers can do those things as options. What we have in our set, and guys, give you an idea, this is my software, okay? This is my software. This is nobody else's software, and I have it out there for those of you that are Tom's Trading Room students. And we got a lot of partners out here that use it. We've got several members that are on tonight that are using this, and we've got a few people that are for one reason or another couldn't see us on the webinar before, or the webinar a couple months ago, or whatever it may be, and now you might be seeing this for the first time. You're like, where do I get this? Well, it's right there. You get it at tomsoptiontools.com. It's the only place you're going to find it, because, like I said, this is stuff that I've used. The money calendar. We've actually, and some of you guys know this, we actually have a contract, and we write a publication for the money calendar through Money Map. But this is the software that we use for that, and we use it right here at Tom's Option Tools. And so, for those of you that we use this software, a lot of people love this software, and we're in the process of applying for a U.S. patent on it as well. Oh, hey Jay, one more thing I got to tell you. So I woke up this morning like I do every morning, and I'm reading Bloomberg because I'm scanning articles all the time, and I don't know if you saw it. Did you see the article about the U.S. Marshals that came in and basically took a Chinese company right out of the CES show? They just pulled them right off the floor because they were infringing on a patent. The hoverboard, those new hoverboards. Well, they had a hoverboard booth there. And I'm reading, I'm like, wow, U.S. Marshals at CES, so I had to see what this is all about. Anyway, long story short, I see my attorney is in there with his legal team and the U.S. Marshals pulling those people out. This is the same guy that's filing the patent for us on the money calendar. And so I'm laughing, I'm looking at him. I had to send him a quick email. I go, what are you doing in Las Vegas? And he was telling me that they've been trying to get a cease and desist order from this Chinese company for since August, and they found out they were at the CES show. They went in and they got them. So funny as it may seem, small world.
Yeah, it may not be.
I also know that it's a small world of option traders, and that I want to thank all of you guys that kind of over the last couple of years followed me over and are part of Tom's Trading Room, and in any form or fashion, whether you're you follow a publication or if you follow the software, or if you take any of the webinars that we do. Most of our webinars are free, as you can see, and that's our goal this year, is to have more and more of these series of webinars that you see. And then, of course, we have premium webinars as well, and we'll be getting into those as we do. We do a handful of those over the course of the year, and so we look forward to showing you some of our premium stuff as we move along. But hey, you know what? This week, it's all about calls and puts. Next week, we're going to get into spreads, and I want to see some homework. I want to see what you guys do with what you have here right now. We've put a lot of it out there to you. So thank you very much, guys, and we'll see you. We will see you next week, right? So, Jay, final words?
Thank you all. Have a great night, safe weekend, and let's see what Monday brings.
Awesome. All right, Jay.
Thank you, Tom.
We'll see you. I'll be talking to you over the weekend, but we'll see you. We'll see you next week. All right, guys. Take care.
You bet. Bye now.